Welcome, cryptonauts, to another exciting episode of the Cryptoholics Corner. Today, we're diving into the world of Bitcoin ETFs. Now, if you've been wondering what exactly a Bitcoin ETF is and whether it's a better option than purchasing actual Bitcoins, you're in the right place. You're intrigued by the potential of Bitcoin, but the idea of managing and securing your own digital coins seems daunting. That's where a Bitcoin ETF comes into play. It stands for Exchange Traded Fund, and it essentially allows you to invest in Bitcoin without the hassle of directly owning and safeguarding the coins yourself. Traditionally, buying Bitcoin involved navigating the complexities of exchanges, setting up wallets, and ensuring the security of your holdings. But with a Bitcoin ETF, you can skip all that. Instead, you simply buy shares of the ETF through your brokerage account, just like you would with any other stock or fund. This means you can easily add Bitcoin exposure to your investment portfolio without worrying about safeguarding and storing the actual digital assets. Now, you might be wondering, is investing in a Bitcoin ETF better than buying actual Bitcoins? Well, it depends on your investment strategy and preferences, but if you're interested in the potential price appreciation of Bitcoin but don't want the hassle of managing digital wallets and security measures, then a Bitcoin ETF could be a more convenient option for you. Investing in a Bitcoin ETF nowadays offers an intriguing avenue for individuals to engage in speculative trading on Bitcoin's price movement without the need to directly acquire the cryptocurrency. ETFs serve as a financial vehicle designed to mirror the performance of a specific asset or group of assets, with Bitcoin being the focal point in this context. Let's dissect the ETF acronym to grasp its inner workings better. The E signifies exchange, indicating that ETFs are traded on exchanges much like regular stocks, offering investors ease of access and liquidity. Meanwhile, the T stands for traded, emphasizing that ETFs are actively traded throughout the trading day, subject to fluctuations in their market value. Lastly, the F represents fund, highlighting the pooled nature of assets within an ETF, enabling it to effectively mirror the target price it aims to track. An essential aspect to note is the regulatory oversight of ETFs by bodies like the Securities and Exchange Commission in the United States. This regulatory framework ensures investor protection and guards against fraudulent activities, adding a layer of security for those participating in ETF trading. Now let's delve into the term Bitcoin Spot ETF. This designation refers to a financial instrument designed to mirror the current market price for Bitcoin. It's pertinent to distinguish this from a futures ETF, which tracks contracts to buy or sell Bitcoin at a predetermined future date, effectively speculating on the future price movements of the cryptocurrency. Buying a Bitcoin ETF is relatively straightforward and accessible, thanks to the plethora of online brokers available, such as Robinhood, eToro, Fidelity, and Webull offer avenues for investors to purchase Bitcoin ETFs with ease. Moreover, individuals can explore the option of including a Bitcoin ETF in their traditional IRA, Roth IRA, or 401k plan, further expanding the accessibility and potential avenues for investment. Now, you might wonder, does a Bitcoin ETF perfectly track the price of Bitcoin? Well, not quite. While the primary goal of an ETF is to mimic the performance of Bitcoin, there are inevitable tracking errors that can lead to disparities between the ETF's price and the actual price of Bitcoin. These discrepancies can arise due to various factors such as market conditions, the management strategy employed by the ETF, or by the associated fees. So let's weigh the pros and cons of buying a Bitcoin ETF compared to purchasing Bitcoin directly. Firstly, ETFs offer a more accessible entry point for the general public, as they don't require extensive technical knowledge or the setup of a Bitcoin wallet with its associated security measures. When you invest in an ETF, you can sidestep the complexities of managing a digital wallet, safeguarding your seed phrase, or worrying about the physical security of your holdings. Additionally, ETFs provide greater ease of trading as they can be bought and sold through numerous popular platforms, offering investors flexibility and convenience in managing their investments. This accessibility and liquidity makes ETFs an attractive option for those looking to gain exposure to Bitcoin's potential upside without the intricacies and risks associated with direct ownership of the cryptocurrency. Indeed, the regulatory oversight governing ETFs offers investors an additional layer of protection compared to the relatively unregulated landscape of direct Bitcoin ownership. When you invest in a Bitcoin ETF, you benefit from the safeguards put in place by regulatory authorities, helping mitigate risks and ensuring a certain level of transparency and accountability. However, it's important to note some drawbacks associated with Bitcoin ETFs. Unlike the actual bitcoins, which can be bought or sold 24/7 on cryptocurrency exchanges, ETFs are subject to market hours, meaning you can't trade your ETF shares when the markets are closed. This limitation can hinder your ability to react quickly to market movements, particularly during periods of high volatility, when swift action may be desirable. Moreover, during times of extreme price volatility in the Bitcoin market, certain ETFs may suspend trading as a precautionary measure. While this move is intended to protect investors from potential losses, this temporary halt in trading could prevent you from capitalizing on significant price swings. Another consideration is the management fee associated with holding ETFs. While these fees are typically modest, they still add to the overall cost of holding an ETF compared to directly owning Bitcoins, which do not incur any holding fees. Furthermore, as mentioned earlier, ETFs are prone to tracking errors, meaning they may not perfectly mirror the price movements of Bitcoin. While efforts are made to minimize these discrepancies, they can still impact the overall performance of the ETF compared to the actual price of Bitcoin. One significant difference between Bitcoin and ETFs lies in their utility. While ETFs can only be traded for cash, Bitcoin holds the unique ability to function as a medium of exchange for various goods and services, offering users a broader range of applications beyond investment. Another critical distinction is the custody aspect. Holding an ETF grants exposure to Bitcoin's price movements, but does not provide direct ownership of the underlying Bitcoins. Consequently, investors are vulnerable to the risk of the ETF issuer facing financial difficulties or failing to fulfill their obligations, potentially jeopardizing their investment. If you're still interested in purchasing a Bitcoin ETF, selecting the right one is paramount. With numerous options available, it's essential to conduct thorough research and consider various factors to make an informed decision. First and foremost, pay attention to the management fees, also known as the expense ratio, associated with the ETF. Lower fees translate to higher overall returns and ensure that your investment closely correlates with the performance of actual Bitcoins. Keep an eye out for ETF issuers offering fee waivers to attract new investors, as this could provide additional cost-saving benefits. Additionally, consider the brand name and reputation of the ETF issuer. Opting for an ETF from a reputable issuer with a proven track record in managing ETFs can enhance the likelihood of accurately tracking Bitcoin's price and effectively managing your funds. If the issuer has prior experience with cryptocurrency-related assets, that's an added bonus as it demonstrates a deeper understanding of the complexities of the crypto market. When it comes to choosing the right Bitcoin ETF, there's one more crucial factor to consider: the ETF's assets under management, often abbreviated as AUM. This metric provides insights into investor confidence in the ETF. Generally, a higher AUM indicates greater trust from investors, which typically translates to increased liquidity. What does that mean for you? Well, it means it's easier to buy and sell your ETF shares when you need to, making it more convenient to manage your investment. Now, let's talk about how the approval of spot Bitcoin ETFs could impact the price of Bitcoin itself. Picture this. When companies issue ETFs, they're required to hold actual Bitcoins to back up the notes they're issuing. This creates buying pressure in the market as demand for Bitcoin increases. As Bitcoin spot ETFs become more commonplace, this buying pressure tends to drive up the price of Bitcoin. But there's more. The availability of a Bitcoin spot ETF also opens the door for institutional investors like pension funds and hedge funds to jump into the Bitcoin game. These big players bring even more buying power to the table, further fueling the upward momentum of Bitcoin's price. And let's not forget about the 2024 halving event, which will slash the generation of new Bitcoin in half. When you combine higher demand with a tightening supply, it's a recipe for a price surge. It's like basic economics 101. When demand outstrips supply, prices tend to rise. Now, before we wrap up, it's crucial to remember that in volatile market conditions, there might be instances where you can't trade your ETF, leaving you at the mercy of the ETF issuer. It's a factor to keep in mind as you navigate the world of Bitcoin ETFs. And that's a wrap for today's episode. Hopefully by now you've gained a solid understanding of what a spot Bitcoin ETF is. Essentially, it's a note issued by a company that holds Bitcoin for its investors, aiming to mirror the price of Bitcoin as accurately as possible. Thanks for joining me, and until next time, happy investing. I'll catch you all in a bit.